Hi guys, this is Cal once again. Today is the 20th of June, Tuesday, MAO with Cal once again. Now, if China economy is in trouble, what about the rest? This is something that we need to cover and it's going to be very important. Lots of information. Let's begin. All right, first of all, disclaimer apply as usual, and thank you AIMS for the kind sponsorship. Okay, so the thing is this, last night, we don't have a US market because it's a Juneteenth day, and of course, it's a public holiday for US itself, so that's why nothing to cover. But then again, the S&P on last Friday apparently actually stopped. Interesting. And of course, if we to see what happened back then in February, could we see a pullback all the way to 42 to 4 level? Or is it just a pullback for higher upside to 4,500? We'll talk about this later. But the thing is this, the main driver was that we have a very huge option expiration on last Friday, $4.2 trillion worth of equity expired. This is incredible, really. This is like in trillions of dollars, and it's that 4.2. That's why you can see the volume itself is pretty big. And of course, usually we have huge volume at the market bottom, but a huge volume with the market at a high level. This is something that you had to be watchful, yeah? Now, China. We know that China has been meeting a lot of people recently. And of course, the thing is this, we all know that they have many empty cities going around. And this is not good at all, because if that's going to continue, that means that the property prices will continue to slump. And of course, people who are paying at a high cost will be in a bad shape. And the thing is this right now, even though they have this, the Belt one Belt One Road thingy that's going on, but it seems that it's not performing. There's a lot of countries that's owing this China a lot of money right now. So this is one of the reasons why China could be in trouble. And of course, if the China market is in trouble, what will happen to the US? Well, we could expect some repercussion, okay? So we all know that in 2019, due to the restrictive trade policy implemented by the Trump administration, China experienced an economic slowdown, and of course in 2020 we got the SARS, the COVID, sorry, my bad, the COVID, and that got even worse. All right. So with all this thing happening right now, we realize that the China GDP numbers are really at the low end. In fact, right now it's at about 3% growth. It's still shy of the 5% set by the Beijing. So the thing is this, mainly is that industrial and retail activity has slowed down quite a fair bit. Retail sales is going down, shows that people buy consumer buying power is actually going down, and of course that will lead to more problem for a lot of business. And of course right now the onshore crude inventories is at a high. Now we know China have been buying a lot of crude, but with a huge inventory, right, it's not the best thing to do unless later on itself, right, they can sell it off. So unless they know that something may happen, and that's why they are stocking up, right? China need to spend more tax revenue. Needs more. In fact, they need to have more tax revenue, risking backlash for middle-class people. Because thing is this, they want to tax more people because a lot of people don't pay taxes in China. And that is why now people are asking the same question. If you are not spending, that's what you can get. So you can see that China don't really spend on social spending. They don't really spend a lot, in fact, compared to Germany, Japan, and US. So definitely that's why the people are not going to pay their taxes. It's very simple. So with all this thing right now, China holds an urgent meeting, and it's basically to ask the business leader to show them or help them to give them idea to stimulate the economy, because right now at the moment, they really need more help. And of course, right now, the stock market is pulled back from the 13,000 psychological level. And of course, if it stays below the 12,796 level, we could see further downside for the market. Now, overall, the South China market is not performing as what it's supposed to do after the recovery from COVID and, of course, reopening of the economy. So I'm going to watch this, guys. If the market loses the MA 200, which is about 12,700 area, this can spell some serious trouble for traders. You need to be very careful. So right now, 12,700. This level has to stay, if not some selling, and that will have some repercussion towards the rest of the stock market. Now, the thing is this, China cuts their key policy rate for the first time in 10 months as the economic rebounds cools, right? So by lowering this, that speaks for itself. So if China can do this after 10 months, you can imagine that what is going to happen. The biggest exporter is having issue right now. How about the rest of the whole world? This is why I'm very worried of what's going to happen in the next few months. And traders, you need to be very careful, because now IMF says that the global economy faces slowdown with a hard landing becoming more likely. Remember, IMF 3 months ago to 6 months ago says that there will not be hard landing, there will be soft landing. Yet and now they have changed their mind. So the thing is this right now, Japan export continue to grow at the weakest pace, even though the Nikkei is at a high level, but you can see the stock market and economy is not going in tandem. In fact, the stock market is being bought up by the institutions, but the economy itself is having trouble. And of course, a lower copper price is usually a very bad thing to be part of the recession. And inverted US yield curve at the level now is like the 40-year low. This is bad. And of course, the shipping rate is actually going down. So we've been covering all this. The Baltic Dry Index has went up in 2021 and it came all the way crashing down in 2023. So all these actually tells you that the core economy is having issues. So if China is down, you can imagine what will happen to the global side. So that's the reason why Fed says that the tightened credit condition likely is going to weigh onto the US growth. We all know that, right? The Federal Reserve really want to bring the inflation down to 2%. And of course, a lot of people are saying that, nope, likelihood they'll bring it to 3% as a target. Now, do note today, tomorrow, in fact, Jerome Powell will have his testimony before the House Financial Service Committee. And of course, he will likely be presenting his case. And this will be highly watched because if he actually says that, nope, there will be a rate hike coming in, they need to really curb inflation, that will spook the market further. Because now we have regional banks faces years of trouble ahead, covered by Wall Street Journal. And of course, Bloomberg says that there's more trouble for the regional banks, the same thing again. So you can see the media are covering right now. And of course, the Americans are not happy at all because they're feeling the strain of inflation. The consumer price index, although it's cooled down for the 7th consecutive month, but you must understand that is not the real deal because the core CPI data is the one that really hurts people, right? That means the shelter prices, rental, and of course, we have the food prices, energy prices. All these are the very, very important things. So that's why you need to be very, very understandable why the Americans are not happy. And of course, right now, ECB diverged from the Federal Reserve, raising rates to the highest level in 22 years. Again, this tells you that the ECB is taking it seriously. They really want to curb inflation, and also they're preparing. If there's one day they need to U-turn, right, at least they got room for it. Because now ECB is 3.5, while the Federal Reserve is at 5.0. So that's the reason why they're going to continue. In fact, they stay there. They'll continue to raise interest rate even in month of July, because they can see very clear that the CPI data for Euro, although it has dropped from a high of 10.5% to current 6%, but the core CPI is not going down at all. This is why this is actually not really the CPI number that dragged down is not really a real deal, because the core CPI you can see is really down by just so minuscule. It doesn't change effect. So that's the reason why you need to continue to hike interest rate. And this is the same thing for US anyway. All right. So the thing is this, ECB says already they are not looking to even think of pausing. All right. So for Jerome Powell to pause on last meeting, honestly, that's a very chicken out idea, but I think he knows that by continue doing this, the stock market or the real economy is going to get hit. And of course, he doesn't want that. So even Thai central banks also hike rate. Okay, they say that the core inflation is high. They don't want to have a repeat of what happened in 1999. So obviously, they need to do a lot of things right now. So think about this. If China is going down in economy and regional central banks are all increasing interest rate, and US yourself is not going to do that, this is going to hurt you bad later on. And that's the reason why you need to be watching out. Now, one thing to note is very interesting. Japan continued to buy a lot of bonds from the US side, and that basically helped the US tie over. And of course, China, the mainland, they actually bought some recently in March, and then again a little bit reduction in April. Not too sure what's doing there, but the main thing is this: right now we all know that with Japan buying so much bonds, likely that's the reason why you can see the Nikkei blasting from 30,000 to 32,000 to 33,000 in just days and days. All right. So sometimes you must understand when you help someone, you get something in favor. All right. So that's one thing. But of course, in expense of the economy, yes, indeed. So this is something that's going to be very, very dangerous at the moment. Now, do note, you can see now the banks are not willing to lend anymore. The willingness to lend the consumer has ran down. It's really at a low level. And of course, that happened back during the COVID period and happened during the Lehman period. So if this is going to go down itself, naturally, you're going to see retail sales going to follow, right? Because retail sales and they move in tandem. And if retail sales goes down the negative zone, oh gosh, that will definitely come out as a very ugly potential recession. So that's the reason why right now the affordability of housing has gone ridiculous. Now look at the housing cost itself. Now the cost has went up from 400,000 back in 2008 and 9, and now it's trading at, they're doing it about nearly 500,000. And of course, this is really, really crazy because it's like at 5.61 times of the annual income. Now, to take a look at the annual income, you can see this, the annual income hardly really go up much, all right? And yet the prices jump up so badly. So you can think about this right now, more and more people are getting very angry because they cannot afford for their homes, or their mortgage costs keep on escalating, multiply by the interest rate too. So this is crazy. If you do not want to continue to do that, so they may just, do a lot of bad debts, and that will really crash the economy. So the problem is this: the housing price is running out of all the way up, and the cost for the mortgages is only all the way up because of interest rate. But if the Federal Reserve don't do that, the inflation will continue to rise, and of course that will become a double whammy. So that's the reason why now Bank of America have two camps of people in the same company. Now Bank of America, we know that Michael Hanna is one of the bearish analyst, but recently he didn't flip, but he has said that he is wrong, and he believed that there will be the start of the end of the bull market, in fact. So that is what Hanna is saying, but his colleague doesn't think that way. His colleague thinks that the S&P market, bear market, has now dead, and there will be further upside to go. So from the same company, two different camps. So you can understand how chaotic is this right now for a lot of people. But the main thing is this, as I tell you guys, the core CPI data, although yes, came down by 1%, but do understand this is not going to help because the Federal Reserve increased the interest rate by 5%. So even though from 6.6 dropped to 5.3 is a little bit more, then it came off a bit, but it's not going to help because if you look at it right now, guys, this is crazy. Look at this, on year 2000 all the way to core CPI is at 2.3% at best. But today, where we are now, we are at 5.5%. This is ridiculous. We're like whole 3% higher. And of course, we all know that, right? This is just only an average out. I'm pretty sure if you go to grocery stores, you go to get your bread, you get your basic necessity, you know that the price went up by 10 to 15%. So this is really just an indication. And of course, with the number at a high period, it's going to be very difficult for Federal Reserve not to do anything, right? So that's the reason why now the regional Fed indicator points to recession, okay? So this is a percentage of federal regional manufacturing indices in contraction. And guys, this is really crazy. Whenever this indicator hits 100 since 1970, 1975, 1980, 1985, you can see that always there will be a recession. Of course, there were a couple of them that didn't have it because they missed it for a short moment, but majority of that itself, you will have recession. Of course, some say that, nope, then maybe this time around we won't see recession. I'm so sorry, guys. With China behaving in this manner right now, it seems that this will likely be happening, okay? So I'm going to still stick with my guns. I'm going to write it down one more time for everybody understanding. I believe that by August to September period, we will actually see a recession. Of course, now the market is shooting a goalpost. They think that the recession coming in this in October to November, but I'm going to put myself up front here. I believe August, September, we will see a technical recession, even though now we do not have a negative quarter, but we all know that someone has massaged the numbers. So remember that just 1 year ago, the Dow was trading at 31,411, and the time we have this celebratory dinner, and of course, everyone enjoyed it. And remember that back then itself, when 1 year ago, the indicator itself, right, was 11 between the indicator was at extreme fear, and that was at 11 to 12. I think that was how low it went. And of course, right now, today, with the extreme greed. So now the thing is this: 1 year ago with a bottom, and now 1 year later, I think we are near the top for this round. And of course, you can see my point. This is where we were 1 year ago at a price, but you know the interest rate was at 1.5%. And of course, after that itself, right, the market did actually came down again for one more wave, and that's whereby we all know that the Federal Reserve came in heavily to save the world. Now, what I don't understand is this, guys. Let me take a look over here. Now, with the market at this bottom, and it went all the way up itself, right? The bullishness were there, but it was never near insanity as compared to today. Now, this bull market that's moving on right now is like less than half of the run back then. And of course, you can see the market has been ding-donging for loads of time. And this push-up itself, to me, is just part of it. So for me to call for a buy right now at this point here itself, I just cannot understand, because you can see right now, the interest rate is at 5% and compared to the 1.5 when we were doing that. So of course, if you ask me itself, right, I believe that this could actually be the start of the selling wave. But of course, the market has to break the 200-day MA. And of course, as long as the market don't break the 200-day MA, the bull currently now is still intact. But once the market breaks the 200 MA, I can tell you this, guys, selling will be really torrid. Okay, so watch out for this. This is very important, and that's why I don't understand why a 10 days rally have anything more confident of an upside when it was like here's more than 20 days, right? Okay, so that will be all for today's MAO. I really wish you all the best for trading, and remember, guys, trading is not difficult. It's all about yourself. Okay, this is Cal signing off. See you then. Bye bye.